Okay, so now we have finished pretty much explaining what makes up the accounting equation. Your assets equals your liability plus stockholders' equity. We broke it down, the asset into its categories with its definitions along with examples. You also received definition and examples of liabilities, and I pretty much summarized in detail the structure of stockholders' equity and how everything pretty much connects with that. Now what we're going to do is move forward and take that concept of our value of assets always equaling the liabilities plus stockholders' equity and apply it to scenarios in which we have transactions. Some transactions that take place. Transactions are just day-to-day activities that engage within the business, and we're going to see how it's affecting the accounting equation. That's the very first step to understanding accounting. All right, so I'm going to take some examples out of chapter 1, page 15. And the first transaction we're going to talk about is owner's contribution. All right. So suppose that a particular company decided to issue, I don't know, let's say $30,000 worth of stock. Okay, so let's say you start a company and you issue stock. That's the first thing you have to do in order to start a company is issue stock. So let's say that the company has issued $30,000 in stock for cash. Okay, so one thing's very important with accounting, guys, is that you have to pay attention to keywords. Keywords will summarize and make your life a whole bunch easier with accounting. Okay, so this particular guy issued stock. This company issued stock for $30,000 cash. That's the sentence. What are the key words? Issued stock, $30,000 cash. Right? Keywords. Issued common stock. Issued stock. Stock is a key word because we have an account called common stock. Cash is also a key word because we have an account called cash. Right? Okay. So issuing stock for cash. Right? So how would that affect this accounting equation? Okay, let's take the word issue stock. When you issue stock, you issue the stock, and in return, you receive the cash. That's what the company does, right? So common stock, to be particular, affects one of these sections of the accounting equation. Which one? Stockholders' equity. Why? Because we know common stock is a part of paid-in capital, right? So when someone issues stock, I'll just write that here, issue stock. Someone issues stock. Let me back this up for y'all to see. When someone issues stock, it's going to affect our stockholders' equity. How would it affect our stockholders' equity? It should increase our stockholders' equity. Why? Because common stock has increased since we issue more common stock. So stockholders' equity is going to increase. Through which account? Our common stock account. Common stock is a part of paid-in capital, and paid-in capital is a part of stockholders' equity. So our common stock account is the account that's being affected, and it's increasing our stockholders' equity by $30,000. It's increasing our stockholders' equity by $30,000. So our stockholders' equity went up. I can rewrite this better for you guys to see. I'll write it a little bit bigger so y'all can see. Our stockholders' equity went up $30,000 from what account? Common stock. And the other key word was cash, right? Receive cash. So we receive cash for issuing stock. Cash is considered a what? Asset. Cash is a part of the asset category. So our assets went up by $30,000 under the account cash. Okay? And this was issuing stock. Okay? So cash went up $30,000, which is an asset. Common stock went up also $30,000, which is a part of stockholders' equity. Okay? Let's look at another one. The other one said, suppose that the company purchased land for $20,000 cash. Purchase land, $20,000 cash. What are the key words? Purchasing land, $20,000 cash. Now, this is when your 2-second business come into play. Suppose you purchased land for $20,000 cash. What happened to your business just now? Well, land came in, so land increased in your business. Land happens to be a part of what category of the accounting equation? Assets. So your assets went up $20,000. Under what account? Land. And what was your other key word? Cash. Paid, cash. Okay? Just a side note, anytime that you see the word paid, the only way that we pay something in America is with cash. So anytime that you see the keyword paid, cash always goes down. Paid, cash always goes down. That's a trick for you. Anytime you see the word paid, you know cash always go down. And cash happens to be a what? Asset. So our assets went up through land, $20,000, but they also went down through cash. In this situation, did we have any liabilities? Was there anything that we owed when we bought land for cash? No. So our liabilities was zero. Stockholders' equity, broken down into two parts, paid in capital and retained earnings. Was anything affecting paid in capital or retained earnings? Paid in capital affects common stock, issuing stock. Retained earnings affects what? Income, revenues and expenses, that kind of stuff. No. So, at this particular time, our assets still equals our liabilities, plus stockholders' equity. How do we know? Because we have plus 20,000 minus 20,000 will give you what? 0. We had no affected liabilities, which gives you 0. And we have no effect in stockholders' equity, which also gives you 0. Look at the previous example when we issued stock. This was purchasing land. Look at the previous example when we issued stock. How did we know that our accounting equation was settled? Well, assets went up by 30,000. Did we have any liabilities? No. And common stock went up by what? 30,000, which is a part of stockholders' equity. So our assets always have to equal our liabilities plus stockholders' equity. Based on that first example, our common stock and our cash, we had assets equaling 30,000 increase and our stockholders' equity equaling 30,000 increase. No effect on liabilities. So at all given times, any transaction should always keep your accounting equation in balance. Okay? Let's look at another one. Purchase office supplies on credit. Suppose that we purchase office supplies on account. Those are the words. We purchase office supplies on account. So we bought some office supplies and we bought them on account. The first problem is you have to identify the fact that you didn't pay cash for it yet. How do you know? Because you bought it on account. When you buy something on account, no cash was involved. So no cash was involved in this, yet we still made a purchase. We just didn't pay. That's why you didn't hit a keyword paid. Okay, so we purchased supplies on account. Keywords, account. And the other keyword was supplies. Well, supplies is a keyword. Why? Because we know supplies falls in what category? Assets. Supplies are assets. And since we bought the supplies, what are the supplies doing in the company? Increasing. So supplies increased our assets by $500. Through the account called supplies. Did we have any liabilities? Liabilities are things that we owe, right? And now we bought some supplies on account. Did we pay for them yet? No. Do we still owe on them? Yes. The key word was account. Okay? Now let me explain something to you, and I want you to listen carefully. Anytime you see the word account, that's going to be a key word, because you can sell something on the account or you can pay something on the account. If you pay something on the account, you still owe, which means paying on the account, you pay for something on the account, you have to set up an account payable. You see the connection? You have to set up an account payable. We saw all payables with what? Liabilities. Why are they liabilities? Because they owe. Accounts payable means that you're going to pay in the future on this account. In contrast, if you sell something to somebody on account, they owe you. So you don't set up an accounts payable. You set up an accounts what? Receivable. You set up an accounts receivable. So accounts receivable is not a liability because the last name is a payable. Accounts receivable is actually a what? Asset. So back to this situation, we bought some supplies on account. We purchased the supplies increased our assets by $500. But what else did happen with our company? Our liabilities went up too. Very good. Our liabilities went up $500 through which account? Account payable. Very good. Now, do we have any stockholders' equities, things that affect from buying stuff on our account? Any revenues? No. Any expenses? No. Revenues are what? When you provide a service or sell a product. Did we issue stock? No. Nothing affects stockholders' equity on that side. So that's a big fat zero. So again, we see that our assets went up 500, liabilities went up 500. Nothing affected our stockholders' equity. So now we are in balance. And this was an example of purchasing on account.